Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. In this section, we're going to dive into equity investments, which outlines and details how companies account for owning shares in other businesses. In the previous video, we learned about debt investments, where companies act like lenders. They lend money to another corporation or sometimes the government. But this week, we're going to explore what happens when they act like owners. So there's some critical events that take place over the life of an investment whenever there's equity in another company, such as shares of common stock. So the first thing that ultimately happens is that they purchase the equity security. So as mentioned, the key difference between debt investments is equity is that with debt, you're lending money versus with equity, you become a owner. You're investing into the corporation. So there's purchasing the equity security. And then because you invested into the company, you receive what's called dividends. So dividends, that's ultimately if the company is doing good at the end of the year, they're not required to, but obviously if the company is doing good, if there's anything left over, they issue dividends out of retained earnings. Holding the investment during periods in which the investment's fair value changes. So again, the stock market is volatile. It can change based on what's happening in the market itself, based on what's happening with politics in the world and things of that nature. So there are increases and there are decreases. And then lastly, selling the investment, that's where you recognize the gains and the losses. So the key thing is that while you're still holding the stock, you haven't sold it as yet. Those are considered unrealized holding gains and losses. But when you actually sell the investment, that's when it's considered a realized gain or loss. And then it is going to be reported on your tax return. So here we have an illustration reporting categories for equity investment. So as we see here, we use three different approaches to account for equity investments. As we learned about debt investments, we had held to maturity, trading securities, and available for sale. Here we have some characteristics, and depending on the characteristic, that determines which reporting method is going to be used by the investor. So when the investor does not have significant influence over the operating and financial policies of the investee, this is typically when they own less than 20% of the stock. Then it's considered that they do not have significant influence. The investor rather has significant influence over the operating and financial policies of the investee. This is typically when they own between 20 and 50% of the stock, and then they control the investee when they own more than 50% of the stock. So we're looking at this first column just so that way you can understand the difference. The first is that they do not have significant influence. This is if they own less than 20% of the voting stock. They have significant influence if they own between 20 and 50% of the stock, and they control the investee if they own more than 50% of the stock. So definitely keep that in mind. And then next we have the reporting method. So if they do not have significant influence, they own less than 20%, then they use the fair value through net income option. So this is similar to the trading securities approach used for debt. So the investment is going to be reported at fair value, and the unrealized holdings and gains and losses, those are going to be reported in net income unless the fair value is not readily determined. In the event that they do have significant influence, they own between 20 and 50% of the stock, then they use what's called the equity method. And in such case, the investment is going to be reported at the cost adjusted for the investor's share of any subsequent earnings and dividends of the investee. And then lastly, when the investor controls the investee, that's again when they own more than 50% of the voting stock, then that is considered consolidation. And ultimately, the financial statements of the investor and investee, they're combined as though they are a single company. So as we go through the next slides, it's going to be very important for us to discuss or determine rather, when we look at the different scenarios, do they have significant influence? Do they not have significant influence? Do they control the company? And that ultimately determines if they're going to use the fair value through net income method, the equity method, or the consolidation method. So with this illustration, this is just an example of an equity investment accounted for as fair value through net income. So again, this is when they own less than 20% of the voting shares, and this is considered that they lack significant influence over the investee. So here it states the following events during 2027 and 2028 pertain to United Intergroup's investment in the common stock of Argent Inc. So here's a story. United invested 1.5 million into Argent, and then over the next year, they'll collect dividends, they'll adjust the fair value, and eventually sell. So this, example just kind of helps to bring the theory to real life, because this is ultimately what happens in the real world. This investor lacks significant influence, so we account for it like trading securities. We use the fair value through net income approach. So this would essentially be our journal entries. Here we see when we initially purchased it, we're going to debit investment in equity securities, right? We have an asset worth 1.5 million, and we paid for the investment with cash. So we credit our cash because cash is decreasing. So simple basics. This is going back to the basics of bookkeeping. Next, we recognize investment revenue. So we're receiving cash in the amount of $75,000. Why? Because there was dividend revenue, right? The owners did not invest it. It's not common stock. We did not borrow it. There's no liability. We earned it through dividend revenue. So that is our credit. All right, so basic, simple journal entries. Again, that's why I stress the importance of ensuring that you understand the fundamentals of bookkeeping, understanding the double entry accounting system, because when you see these journal entries, you'll understand, because accounting is the language of business, and we're basically telling a story using numbers. So in the event that we need to adjust for the fair value of the stock, again, we're treating it the same way that we treated trading securities under debt investments. So here we see that they valued the Argent stock at 1.45 million. So we paid $1.5 million for it, but now it's worth 1.45 million. So the value of it decreased. So in such case, we need to make a fair value adjustment. And in this case, we have a loss, right? We paid 1.5 million for it, but now it's worth 1.45 million. So we're going to make an adjustment through our fair value adjustment account. Right now, we need $50,000 to put a down payment, and we have $0 in the bank account. So therefore, we need to earn $50,000. So when you look at the T accounts, as we see here, again, you want to use that logic. This is what the balance needs to be. How much money is there? That ultimately determines how much we need to debit or credit that account for. So in such case here, we see we debit loss on investments, unrealized net income, and we credit the fair value adjustment account. And one key thing to keep in mind is that the carrying value of the equity investments, again, they need to be adjusted to the fair value at the end of every reporting period. It's similar to trading securities. So now what happens when we ultimately sell it? So we adjusted the securities to the fair value, and now we're essentially doing it again. So in this case, now it's worth 1,446,000. Before it was worth 1,450,000. And now the value of the equity investment, it decreased even more. Before it was a decrease of 50,000. Now it's a decrease of 54,000. So in such case, we already have $50,000 in the bank. We need 54. Therefore, we need 4,000 more. So we record the journal entry to adjust it. So we debit the loss on investments of $4,000, and we credit fair value adjustment. And then now we're going to sell it. Maybe the company decides, hey, you know what? Before it goes down to $1 million, let's recoup something, right? So in such case, they decide to sell it for the fair value as of January 5th. So therefore, they're receiving cash of 1,446,000. Remember, initially they paid 1.5 million. So in such case, there's a loss of 54,000, but we were making the fair value adjustments throughout the life of the equity investment. So therefore, that is why we debit the fair value adjustment account, because in our two previous entries, we accounted for the loss. All right, so this just, kind of shows us to adjust the remaining equity investments. All right, so it decreased again to 1.3 million. So in such case, now we need to adjust the remaining. Here we see the balance as of 12/31 was 50,000, and the balance, the fair value is now 1.3 million dollars. So now we figure, hey, okay, now the total decrease in value is 200,000. So now we need to increase it by another $150,000. So this is assuming, all right, I know that was a little confusing because of the changes in the texts. So let's see here. I'm going to scroll back up one. All right, so this is the 1,450,000. So we're building off of this example. So the next slide that we're going to see, this is assuming they did not sell it. So we originally paid 1.5 million, and now the value is 1.45 million. So this was an isolated scenario where they decided to sell it, but let's just say this never happened, right? They didn't sell it. We see that the value, it was 1.45 million. Now it even declined to 1.3 million. So that's if United decided, you know what, they're not going to sell it. They probably should have, because now they're losing, a great amount of money, but things happen. We know the market is volatile. So in this case, they didn't sell the stock. They would just keep reporting and recording whatever the fair value adjustment is going to be to get it to the fair value. So in such case, now the fair value is 1.3 million. The cost was 1.5, so therefore the necessary fair value adjustment needs to be $200,000. So therefore, we need 200,000. We already have 50,000 in the bank account, so therefore the journal entry amount is going to be 150,000, a debit to loss on investments and a credit to the fair value adjustment. So these slides that we just covered, they basically show the journal entries step by step. So the key thing is that when we are using the fair value through net income, everything flows through net income. Again, it's similar to when we were dealing with debt investments, that the equity investments, they are going to be adjusted so they are reported at fair value. Dividends are considered revenue, and fair value changes, they hit earnings. So therefore, gains and losses, they're going to be realized in income. So think of it like mark to market. We are always updating to reflect the current value. So just keep that in mind. All right. So when it comes to IFRS, as we know, GAAP, generally accepted accounting principles, they don't always align with IFRS, International Financial Reporting Standards. Sometimes there are some differences. Sometimes GAAP is more stringent. Sometimes GAAP is more lenient, vice versa. So under IFRS number 9, that governs the treatment of debt and equity investments. Under IFRS number 9, investments in equity securities, they're classified as either fair value through profit or loss or fair value through other comprehensive income. And if the equity is held for trading, then it needs to be classified as fair value through profit or loss. All right. So there are some nuances, but just keep in mind, then are you under IFRS? Are you under GAAP? And again, obviously, different rules based on which accounting standards govern these transactions. So as it relates to the financial statement presentation for our equity securities, so we have our balance sheet. If they are short term, if they are going to be sold within 12 months, then they are considered current assets. If they're going to be sold within or more than rather 12 months, then they're going to be treated as non-current assets. So on the cash flow statement, if it's short term, we treat it as under operating activities. And if it is long term, we treat it or report it rather under investing activities. And then we have our notes to financial statement. Again, there might be certain situations where it doesn't impact the financial statements, but they are disclosed on the financial statements through notes. So in those notes, we disclose the portion of any unrealized gains and losses for the period. And remember, the unrealized gains and losses, that means that we're still holding the equity. We didn't sell it as yet, but the value is fluctuating. And then they also disclose how the carrying value was calculated, when the fair value is not readily determinable. So maybe there's some situations where you don't really know what the fair value is. So in such case, the notes to financial statements, they're going to disclose ultimately, for those equity investments for which the fair value is not readily determinable. So we just looked at it, the scenario whereby a company does not have significant influence. And now we're going to look at it when they have significant influence. So again, this is when the company owns between 20 and 50%. So if a company acquires more than 50%, we know that that's control. We're not there yet. So in this case, control exists when a company owns more than 50%, as we just pointed out. The parent company, in such case, they're going to consolidate the financial statements. They're going to combine it. But significant influence, this usually is assumed to exist when they own between 20 and 50 of the investees' voting shares. So what does significant influence mean? Because they own so much of the corporation, they have some pull, right? They have some say so, for lack of a better word. So the decisions, they can be swayed in the direction of that the investor desires. Why? Because they got some skin in the game, right? For lack of a better word. Imagine, right? You have, let's think of it in our own terms, being on the board of a student club, right? You don't run it necessarily, but you can influence the outcomes, right? You're on the board. So your say, your voice ultimately matters as far as what happens. Or let's say you're working at a company and you're a part of the management team, right? In such case, you have a say so in certain decisions that are being made. So in such case, investments where the investor has significant influence between 20 and 50%, in such case, it is accounted for using the equity method. And the investment is initially recorded at the cost, how much you paid for it. The investment balance is adjusted for net income, loss, dividends, and potentially other items. So here we have the scenario. We have United Group. They purchased 30% of Argent. So when we look at this, we're like, wait, 30%? Based on the rules, do they not have significant influence? Do they have significant influence, or do they have control? Based on a percentage, we know that they have significant influence. So therefore, we utilize the equity method. So here we see purchase 30% of Argent common stock for 1.5 million. So we know that we're going to recognize it at cost. So to see how the equity method works, we are using this illustration as we see 30%. So therefore, here we see the fair value of what is this? Okay, fair value at time of United's investment. And then we look at the book value of Argent's financial statements. So they have some buildings, they have land, they have some other identifiable net assets, and then they have some goodwill. Goodwill, basically think of it as something of value to a company that does not have a tangible presence. So tangible basically represents something that you can physically perceive with your five senses. You can see it, you can touch it, right? But intangible, it has value, but you cannot see it. So that's basically like someone's character, someone that, they keep their word. We can't physically see it, but it's of value to a person, right? So then we just have some other information, Argent's net income, Argent's dividends declared, and things of that nature. All right, so here we see that's how we determine the purchase price. Then we also see the buildings. It lets us know there's a 10-year remaining useful life. There's no salvage value. And then we have other net assets, and this is basically other assets minus the total liabilities pretty much. All right, so just giving us some greater insight about what's going on with Argent. So now we're figuring out, okay, well, what does our journal entry need to be? So we are going to debit the investment in equity affiliate account, and we are going to credit cash. So we see that obviously there are some differences, some nuances between which accounts are going to be debited and credited. So when we saw the previous example, I'm just going to go back a few slides when they did not have any ownership, or they didn't have significant influence, rather, we see that it was an investment in equity securities. But That's essentially when they do not have significant influence. Now, when they do have significant influence, in such case, the debit is going to be to investment in equity affiliate. So you want to keep that in mind. So as you prepare for the CPA exam, professional exams, there is a different account title that is used when you are dealing with the different types of significant influence. Do they have the influence? Or do they not have the influence? All right, so next we move on to recording the investment revenue. So as we know, we own 30%. So therefore, their net income was 500,000. Because we own 30%, we are going to get 150,000. So therefore, we debit investment in equity affiliate and we credit our investment revenue account. So under the equity method, the investor, they're going to include in their net income, again, their proportionate share of net income. They had income of 500,000. We own 30%. So you know what? We get $150,000. And that is going to be reported as their investment revenue. And just keep in mind, just in case they had a loss, then in such case, they would reduce their investment. So it would basically be a reverse, pretty much, right? If they had a loss. And then now we're looking at the example in the event that they receive dividends. Same logic. They declared and paid 250,000. We have 30% ownership. So therefore, we received cash of 75,000 and we credit our investment in equity affiliate. So because we recognize investment revenue when the net income is recognized, therefore, when we recognize or receive rather the dividends, then in such case, it reduces the investee's net assets. So there might be some further adjustments necessary when we're using the equity method. So this occurs when the investor's expenditure to acquire an equity method investment exceeds the book value of the underlying net assets acquired. So this basically helps to approximate the effects of consolidation without actually having to consolidate the financial statements. So you might be saying, what? This doesn't make any sense, right? So one of the key things to keep in mind is that sometimes what happens is that when they acquire it, the amount is more than, let's say that the book value of the assets were, 5 million, but they paid $6 million in order to get the company, right? In such case, it might seem, hey, they're actually purchasing, more. Their proportionate share of ownership is actually more. So that is something to account for. So whenever there's a difference between the purchase price, which I mentioned was 6 million, and the book value of the corporation, which was 5 million, again, I'm just, pulling numbers out of the air to kind of hopefully make it make more sense, then in such case, they're going to have to amortize the difference. So they will adjust the investment account and the investment revenue account to act as if consolidation procedures had been followed. So if the assets would have been written up to fair value, they basically treat it as though it happened. They would impute higher expenses in subsequent periods when those assets are expensed. And that basically allows for the earnings to be lower by the investor's share in that additional expense, right? Sometimes it happens within the real world. So again, the key thing is that we are amortizing it. So whenever consolidated financial statements are put together, they report the acquired company's assets at fair values and then any goodwill for the excess of the acquisition price pretty much. So these are some things to keep in mind in the event that, again, the purchase price is more than the book value. All right, so here we see the sources of differences between the investment and the book value of the net assets acquired. So in our example, United needs to make an adjustment for the fact that when they purchased their investment in Argent, the fair value was higher than the book value of the assets. So here we see the fair value of the investee was 5 million. The proportion purchased by the investor was 30%, which is 1.5 million. The fair value of the investee's identifiable net assets was 3.6 million, by the proportionate share, which is 1,080,000, and the book value of the investee's identifiable net assets, we saw it in a previous slide, was 2.1 million, right? So in such case, we see that there are some differences, right? So with the differences, we see that if it was sold separately for the assets, it would have been 1.8 million. So there's a $420,000 difference, right? They pay 1.5 million, but the fair value, the proportionate amount would be 1,080,000. So there's a 420,000 difference that's attributed to goodwill. And then the difference between their identifiable net assets, the fair value and the book value, we see between theirs two, there's a difference of $450,000. So in such case, they attribute a portion to the building and then a portion to the land. So as you can see, this is obviously very nuanced, but it happens day to day. So when these companies, they have equity investments of another corporation and they pay more in comparison to the fair value and the book value of the company's assets, these are the adjustments that need to be made. And this is just essentially how they would account for the additional depreciation. So in such case, we see that the fair value at the time of the investment was 2 million, but the book value is 1 million. So we factor in the difference, which is 1 million. We multiply it by the 30%, which represents our ownership, and then we divide it by 10 years. And that is how we determine that, well, we need to decrease our revenue by 30,000, and we also need to reduce the balance in our investment and equity affiliate by the 30,000. So again, this happens whenever they pay more than the company is worth on the books and in comparison to their fair value. So just a few things to keep in mind. Land, this is always going to be the case. Land is not depreciated. So you might say, wait, what? Why is not, land not depreciated? Here's one thing. I live in New York City, and oftentimes I see a restaurant pop up in a specific space, and then there's a laundromat, and then there's a hair salon, So ultimately, the key reason why land is not depreciated is because it never loses value, right? You can always knock down the structure and just build something else. So land does not lose value. The building does because it deteriorates over time, but the land itself does not lose value. So land is not depreciated. This is a common fundamental to remember in accounting. Land's not depreciated, but the difference between the fair value and the book value of the land would not cause higher expenses. So just keep that in mind, especially if you're like in a prime area. Yes, there might be a difference in the value of the land because it's like, especially with gentrification and things of that nature going on, but the land itself is not depreciated. Goodwill, unlike most other intangible assets, again, tangible assets you can see, feel, perceive them with your five senses. Intangible assets, you cannot perceive them, you cannot see them, you cannot touch them, but they have value. The goodwill is not amortized. So with goodwill in situations like this, there's no need to adjust for it. All right, so this is just accounting for how we would treat other assets and liabilities. So in our example, there's no difference between the book value and the fair value of the remaining net assets. So in such case, they don't need to make any adjustments, but that's not always the case, right? This is an exception. So in the example that, let's say they had inventory, that the fair value was more than the book value. So in such case, whenever the fair value is more than the book value, in such case we consider it to be appreciated property, and when the fair value is less than the book value, you have depreciated property ultimately, right? So in such case, when they purchased the investment, in such case they would have to recognize the expense with the higher fair value, but in such case doesn't apply. But just so you know what would happen in the real world if you encountered a situation like that. So as it relates to reporting investments, the fair value of the investment shares at the end of the reporting period is not reported when using the equity method. The investment account is reported at the original cost, which is how much you paid, which is 1.5 million. It's increased by the investor's share of net income, which was 150,000. And then from there, it's decreased by the portion of the earnings actually received, which was dividends. And then we also factor in the depreciation adjustment because their acquisition price was more than the book value. So therefore, as of right now, the balance as of December 31st is calculated as follows: the purchase price plus the share of income minus the dividends minus the depreciation adjustment gives us an ending balance of 1,545,000. And the great thing about this is that this is, again, it's going back to the basics of accounting. The investment in equity affiliate is a asset account. And we know that any amount on the left side, the debit side of the asset account, increases it, and any amounts on the right side, the credit side, decreases it. So that is overall how we get the balance of 1,545,000. So we just saw a simple scenario, right? But obviously, as we know, purchases are not always made January 1st. Sometimes they're made December 10th or December 1st, right? Or April 15th. In the real world, purchases are happening at various times of the year. So whenever investments are acquired mid-year, we only recognize the investor's share of the year's activity. So for example, let's say United purchased 30% of Argent on October 1st. So instead of them getting the, full share of income for the year, it's not going to happen, right? Yes, they would have received 150,000 for the entire year, but they only had it for 3 out of 12 months. They only had it 25% of the year. So therefore, it's the 150,000 multiplied by 25%, or 3 out of 12 months, October, November, December. So 37,500. We do the same thing for dividends and the same thing for the depreciation adjustment. So that's the only nuance when it's purchased mid-year. You basically, need to do a further proportionate amount based on the number of months that the investment was held. Here we just have a quick illustration with AT&T, how AT&T reported their 2022 investments in their affiliated companies for which they had significant influence. They own between 20 to 50%, so therefore they used the equity method, as we just learned. So now we consider, right, much like our debt investments, sometimes there's losses, right? Sometimes the value of the investment, it declines. So in such case, what happens? So in the event that when we're using the equity method, the fair value of the investment, it declined below the current value. In the event that the decline is temporary, the investor, they're going to recognize what's called an impairment loss, right? And it's going to be recognized in net income. But in the event that, let's say, it's permanent, then in such case, it's going to actually be recognized. So those are some things to consider. So if the decline is viewed as other than temporary, then they're going to recognize it as an impairment loss in net income, reduce the carrying value on the balance sheet, and then they'll continue accounting under the equity method. So that's the key thing. Is it temporary? Is it other than temporary? Do we think that it's going to be permanent? So these are some things to consider. And then what happens if the conditions change? What happened if, they went from not having significant influence to now having significant influence, to go from, having significant influence to not having, much like when we dealt with debt investments and we saw the transfers. What happens if the conditions change? So a change from the equity method to fair value through net income, there's no adjustment necessary for the remaining carrying amount. The equity method is going to be discontinued, obviously, because they no longer have significant influence, and the investment is going to be accounted for as fair value through net income from then on. And the balance in the investment account is going to serve as the starting point for the new method. But let's say that is a change from not having significant influence to now having significant influence. In such cases, securities, they're going to be marked to fair value. And any unrealized holding gains losses, they're going to be recorded in the income statement. And any cost of additional shares, they're going to be added to the balance sheet. And that balance is going to be adjusted going forward because, again, now it's going to be treated like trading securities for debt investments. And the disclosure note is going to describe the change because, again, with these disclosure notes, keep in mind with the financial statements, it's just numbers. But with a disclosure note, it now gives the investors more of an understanding of the differences. So think of it like a book. Like I mentioned earlier, accounting is the language of business. You're telling a story with numbers. But you've ever read a book? We read with words, but the benefit, depending on the book you're reading, when you have a picture, it kind of helps you to better visualize and understand what is going on, right? In the text that you're reading, the same thing. We have the financial statements, we see the numbers, but the disclosure to notes, it brings more clarity to what is happening with the numbers. So just think of it like a picture book, when you're considering the disclosure notes and the purpose of them. So if an equity method investment is sold, what is going to happen? So when an investment is reported by the equity method and it's sold, we need to recognize the gain or the loss. And that ultimately depends. Is the selling price more than the book carrying value? Then it's going to be a gain. Is the selling price less than the book carrying value? Then a loss is going to be recognized. Just a quick teaching moment. I remember a few years ago, I didn't remember the signs, right? I graduated from elementary school, middle school a very long time ago, so I didn't remember. And I don't want to assume everyone does because there's so many other things for us to remember. So just a quick little tip if you find yourself struggling like I once did, ain't no shame in my game, right? With remembering the difference between which sign is greater than, less than. A tip for me to always remember is that the less than looks like an L, right? Wow, so easy to remember. So with such case, then the L, the one that looks like an L, that is the less than sign. And another thing that my son ultimately taught me is the side where it's like, think of this like an alligator's mouth. The side that the alligator's mouth is eating, that's the amount that has the greater value. So my son taught me that, my 6-year-old, soon to be 7. All right, so just a quick little tip. All right, so again, when it looks like an L, that's the less than sign. And another way, think of it like an alligator mouth. The side that the alligator is going to eat, that amount represents the larger value, right? So just felt like, sharing some extra little knowledge. So here's a quick example. The balance of United's 30% investment in Argent at December 31st is 1,545,000. United sells its investment in Argent on January 1st, 2028 for $1,446,000. So based on this, we see the book value is 1,545,000. We sold it for 1,446,000. So in such case, this is what's going on. We sold it for 1,446,000. The book value is 1,545,000. We have a loss on investments of $99,000. So this is the journal entry that would be recorded. So here we just have a comparison of the fair value and the equity methods. All right, remember we use the fair value through income when they do not have significant influence, that is less than 20% of the voting stock. The equity method is used when they own between 20 to 50%, and when they own more than 50%, they have control. So therefore, there are combined consolidated statements. So you can take the time to go through this a bit more just to see the differences, the nuances between the fair value through net income and the equity method. So a few things to keep in mind, because when a decision is made, some decisions, there's no take backs, right? Certain decisions, once they are made, you're stuck with them. Or to get out of that decision that you made, there's a long process, right? So companies, they can choose to use the fair value option, the FVO, for significant influence investments that would otherwise be accounted for under the equity method. So they do have that. But The irrevocable decision about whether to elect the fair value option or not is made by the company, and they can make that election for some investments and not for others. The company is going to carry the investment at fair value in the balance sheet, and unrealized gains and losses are going to be included in the earnings. The investments, they're shown on their own line in the balance sheet, or they're combined with equity method investments with the amount at fair value, and they're shown parenthetically. So there are some alternatives for bookkeeping. The investment is accounted for using the entries that would be used if they lacked significant influence and they use the fair value net income, or they could record all the accounting entries during the period under the equity method and record the fair value adjustments at the end of the period, right? So these are just, again, some alternative ways to basically accomplish the same thing. As we know, sometimes there are differences between GAAP and IFRS. So here we see GAAP for the equity method. It's not a requirement for the fair value option. It provides the fair value option for all investments that qualify under the equity method between 20 to 50% ownership. Under IFRS, number 28 requires the investees to adjust to correspond to the accounting policies of the investor when they are applying the equity method. IFRS does not provide the fair value option for most investments that qualify for the equity method. So again, there are some nuances between GAAP and IFRS. And then this is just talking about the financial instruments and investment derivatives. So a financial instrument is defined as one of the following: cash, evidence of ownership interest in an entity, a contract that imposes on one entity an obligation to deliver cash. So maybe accounts payable. So that's like, let's say, I decided to go and purchase a new desk for my office. In such case, I have this contract and I have an obligation to pay We Make Desks. Let's just say that's the name of the vendor, right? I have an obligation to pay them, right? To deliver accounts payable or another financial instrument and conveys to the second entity a right to receive cash, or a contract that imposes one entity an obligation to exchange financial instruments or potentially unfavorable terms. So let's say the issuer of a stock option and conveys to the second entity a right to exchange other financial instruments on potentially favorable terms. So derivatives, they are financial instruments that derive their value from some other security or index. All right, so ultimately, that brings us to the end of chapter 12. So for the first portion of chapter 12, we learned about debt investments. We know that there are three classifications. We have held to maturity. The corporation has the intent to hold the bond until it matures. Trading securities, they are actively buying and selling them. And then we have our available for sale, where we don't really know if we want to hold them to maturity, and we don't really know if we want to sell them. So they're just hanging in limbo, right? So under the debt investments, we account for them based on the classification. And we just wrapped up equity investments, where they do not have significant influence. They own less than 20% of the voting stock. If so, they use the fair value through net income option. When they have significant influence between 20 to 50%, they use the equity method. And when they have control, they own more than 50%. In such case, they consolidate, they combine the financial statements as though they are one. So that brings us to the end of chapter 12, investments.